sir.
All right, so this is a new topic. It's called Cvpa, and I'm sure that you must have seen this in your past question, where you'll be asked to calculate break-even
Yes.
points in unit and break-even points in value. So after this class, once you see that question in your past question again, just eat it, enjoy it, and pass your exam. As I've said earlier, you don't need to know how to solve all questions before you are sure of passing your exam. Have ideas on all the topics, know them at least 70–80%. Once you see the question in your exam, do it and don't be scared. With that, you will pass. Many people that have passed their exam today, they were not gurus when they were writing the exam. But now they can say, oh, I passed my course, I passed my taxation, and they have moved on. So I'll be dissecting this particular course known as Cvpa, and we'll solve 3 to 4 questions to boost your confidence. Now, let me just give you a general understanding of what Cvpa means. Now, they said cost volume profit analysis talks about the relationship between costs, volume, and profits. So we want to know, as a cost accountant, what relationship between the cost of a product, the volume of that product produced, and the impact it's going to have on profit. That is, we are looking at the relationship between costs, volume, profit at different level of activity. So you agree with me that the quantity of product or activity that we want to achieve in the production department will depend or is tied to the costs. So if we say we want to produce 1,000 units of product, the cost of producing 1,000 units of product is also different from the cost of producing 1,500 units of product. Does that make sense?
Yes, sir.
Yeah, the profit you will get from producing 1,000 units of product is also different from the profit you're going to get from producing 1,500 units of product. So we are trying to say that as cost accountants, the cost attached to a product, the volume, that is the quantity of that product, and the profit we intend to get on that product are tied to the activity level. Activity level simply means what we want to produce. So under Cvpa, we want to know what quantity of product should we produce in order for us to be able to cover all the costs. So if you have done your math and you know that you want to produce 100 units of a particular product, and you are going to spend 5,000 naira to produce it. So if you say 5,000 naira is your total cost of producing 100 units, with Cvpa, you should be able to know how much profit you will get from producing 5,000 units of this product, from producing 100 units of this product at 5,000 naira. So what are we trying to say? We are trying to say that with Cvpa, we're able to tell the cost of producing a particular product at a particular level of output. So if you want to produce 100 units of product with Cvpa, we can be able to tell how much we should use in producing that 100 units of product. Now, Cvpa is basically centered on the word BEP. BEP. We call it break-even point. This is it here. Break-even point analysis. For us to carry out a Cvpa, or for us to carry out Cvpa, which is cost, volume, profit analysis, we must understand the principle of break-even analysis, which is also the same thing as Cvpa. In fact, Cvpa is also known as break-even analysis. Are you with me? So break-even analysis is used to represent the position where total cost will equate what? Total revenue. So we as managers want to know the total cost of producing a particular item for 5,000. How much revenue are we going to get after producing this 5,000? After producing this product for 5,000, we're also going to get a revenue of 5,000. Whenever total cost of producing a product is equal to the total money we are going to get if we sell that product, we say that there is a break even. Are you following me? There is a break even. So that is what we mean by break even analysis. So break even simply means a situation where total cost of production is equal to the total revenue you will get in producing that item. Are you getting it? So for you to understand break even analysis, you must also understand what we call fixed cost and variable cost, because the cost of producing an item can either be fixed and can either be what? Variable. No, you know when we are doing absorption costing, I said using absorption costing, both variable and fixed cost forms the cost of a product. Then using marginal costing, only variable cost forms the cost of a product. So for you to understand break-even analysis, which is talking about where total cost equates total revenue, you must know what comprises of total cost. Total cost here is the addition of both fixed cost and what? Variable cost. Are we good to go?
Yes, sir.
Now, the objective of CVP analysis is to provide solution to the undermentioned question. Whenever a cost accountant or managers have questions regarding to all this here, they can use CVPA to determine it or to analyze it. For example, how many units must an organization produce and sell in order to be able to absorb the total cost of production, or what is the break-even point in units? That's what it means. Break-even point in units simply means how many units should we as a company produce so that all our costs that we're going to incur in producing this item will be covered by this unit. As I was explaining here, if we spend 5,000 naira to produce a product, how many units of that product should be produced that if we divide it, we are going to be able to cover the whole cost of 5,000 naira? You know, you hear some people saying, I made loss in my business. Why did they say they are making loss? Because the revenue that they got was less than the cost of the product. Do you understand?
Yes, sir.
Good. So for break-even analysis, we want to know, now that you know that we are going to spend 5,000 naira to make these bonds for this student, how many units of these bonds are we going to make so that we'll be able to get this 5,000 naira back? That is what we are trying to say. So whenever managers are faced with that kind of decision, are you getting me? They use CVPA analysis or break-even analysis to determine that. B says that what is the total turnover required by an organization in order to equate the total cost of production, or what is referred to as break-even point in sales. So in break-even, we have break-even point in units and we have break-even point in value, which is also known as sales value, or in naira, since you are in Nigeria. Now, under break-even point in value, we are trying to say the total turnover. Turnover here simply means sales required by an organization in order to equate total cost with what? Of production. Are you getting it? In order to equate what? Total cost of what? Of production. So how much must you sell? Are you getting it? How much should you sell a unit of your product? If you know the quantity that you want to sell, how much should you sell one unit so that you'll be able to get your total cost of production? In this case, how much are we going to sell one unit? 50 naira. So that when we say 50 naira times the whole 100 unit that we have produced, we'll be getting the total cost of production that we are concerned about. Remember that in this case, we're only looking at the cost. We're not talking about making profits. Because break-even talks about total cost equal to total revenue. And when total cost is equal to total revenue, there is no profit and there is no loss. Do you understand that?
Yes, sir.
Good. So we have been able to understand that break-even point can be used to get what? CVP analysis can be used to get what? Break-even point in unit, which means the total units you need to produce, Abi, for you to get back
Yes,
what?
sir.
The total cost that you have incurred. Then break-even point in value means the total, how much should you sell a unit of your product so you'll be able to get the total cost that you have what? Incurred. The beauty is that if a question tells you that A, determine the break-even point in units, B, determine the break-even point in sales value. If you have gotten your units, the only thing that you need to do is to say units multiplied by sales per unit. You will get your break-even point in units, in value. So that's what I did here. Since I already know my unit is 100 naira, which is my break-even point in unit, I will just multiply it by how much did I want to sell one? 50 naira. That is going to give me my break-even point in what? In value. So break-even point in value is simply break-even point in units multiplied by selling price. Are we good to go?
Yes.
Good. The next one is, what will be the turnover required by an organization for the purpose of achieving a predetermined level of profit?
So is break-even point in sales the same thing as break-even point in value?
Yes, break-even point in sales value is the same thing. Value is sales. You get it now?
Yes.
Yeah, so it's the same thing. Whether they ask you break-even point in value, whether they ask you break-even point in sales, whether they ask you break-even point in naira, because the question is going to be in naira. Even if they ask you break-even point in dollar, in as much as they are referring to something that refers to money, it becomes what? Value. Are you getting it?
Yes, sir.
Okay, so C says, what will be the turnover, which I said turnover is sales, required by an organization for the purpose of achieving a predetermined profit level? Now, here the manager wants to know, how much are we going to sell for us to get a profit of 50,000? So if, for example, your parent or you have somebody that is dealing in the sale of a particular product and the person wants to know how much should he sell so that he's going to make a profit of 50,000, you can use CVPA to determine it. I just finished making this yogurt, oh, and this yogurt, we have 100 pieces. I just want to make 50,000 naira from all this yogurt. How much can I sell this product? With CVPA, you'll be able to know the exact amount you will sell per unit of the product. So that once you multiply it by all the units that you have produced, your profit of 50,000 naira is going to come out. That is what we use CVPA to do. Let's come down to the assumptions on CVPA. Are you getting it? The other one is D,
Yes.
which is under a predetermined amount of profit, how many units must an organization produce? So if you want to make 50,000 unit profit, how many units should you produce to make this profit? CVPA can also do that. Remember here, we have the units. We want to know how much we will sell to make a what? A profit. Here, we know the profit we want to make. We want to know how many units we should produce to make that what profit. So if I want to make 100,000 naira profit now on this my drink that I'm making, how many units should I produce? CVPA will be able to answer that question. You will begin to see the interesting part of it when we start solving questions. So CVPA is a decision-making tool by managers. For CVPA to work or for break-even analysis to work, are you getting it? The
Yes,
following
sir.
assumptions must hold. What are the following assumptions? It is assumed that there will be uncertainty. That is the first assumption. So you can be told in your question that what are the basic assumptions underlining break-even analysis? Uncertainty, that means you must not be sure about some things. Are you getting me? So you are not sure about the quantity you are going to produce. That is why you are using CVPA. You are not sure about the selling price of the product. That was why you are using CVPA to detect or to determine the selling price. So there's usually uncertainty. That is why you are using CVPA to decide what it's going to be. Now, all other variable costs remain constant. That is, variable cost is constant.
They said there will be no uncertainty. Does not mean that there will be certainty. No uncertainty.
Yeah, it is assumed that there will be no uncertainty, that there will be no risk and uncertainty. So there's no uncertainty. Simply means that this 100 units that you are talking about, this 50 that you are talking about, and this 5,000 you are talking about, are you getting it? There is no risk in the future that it is going to affect it. Now, in business, there's what we refer to as a risk. Risk simply means that if you decide something today, tomorrow there's going to be something that is going to make that thing that you have decided today not to work. But under CVPA, this 50,000 naira, this 50 naira that you have decided, are you getting it? That you have agreed that CVPA has told you that it's going to be the selling price. We are assuming that nothing is going to affect it in the future. That is what we mean by there is no risk or there is no uncertainty. So you do not know that this 50 naira is going to be 50 naira. Now that CVPA has told you that, okay, your selling price is going to be 50 naira. Are you getting it? We are assuming that nothing is going to change this 50 naira price in the future. So if we know that variable cost is going to be 10 naira through CVPA, nothing is going to change that variable cost in the future for now. Are you getting it?
Yes, sir.
So that's why we say there's no uncertainty. And again, you see, variable cost remains constant. That explains it. So nothing is going to change this variable cost. So it remains what? Constant. Then next is what? All costs can be accurately divided into fixed and variable costs. Remember, I told you that for you to understand CVP or break-even, you must understand fixed and variable costs. So you should be able to tell which cost is fixed and which cost is variable. Where you are given a figure of, let's say, 500 naira, and they say this figure is known as total cost. I know total cost simply means fixed cost plus variable cost. Are you getting me? For the purpose of CVPA, you need to be able to determine how much of this 500 naira is fixed cost and how much of this 500 naira is variable cost. For you to do that, you must use what we call cost separation techniques using high and low method. So remember, I told you I'm going to teach you high and low method under cost separation technique. We are going to be looking at that inside this topic. So remember, I said whenever you are giving total cost, and you know for CVPA, you must be able to divide based on the assumption total cost into fixed and variable. But since you are giving total cost, you must make use of high and low method to separate fixed cost from variable cost. So if you are told which method is used to separate fixed cost from variable cost, we can use high and low method to do that. We can also use another method known as regression, but they will not tell you to use regression. Basically, we use high and low method, but I'm not trying to give you the various methods that are used to separate fixed cost and variable cost from total cost. So we have high and low method. We have regression method. We have account balance method. Please take note of that. We have account balance method. So let's proceed. Here are the other assumptions. We say there are no stock level changes, or that stock are valued at marginal cost only. So stock levels are not changing. Are you getting it? Then the analysis is
Yes.
applied to the relevant range only. So all these are the assumptions. Profit are calculated on a variable costing basis. So at least know 5 of these assumptions to be safe in your exam. Are you with me? I want
Yes,
to
sir.
talk on 9. Fixed cost will remain constant within the relevant range. We already know that. Fixed cost is always fixed within the relevant range of production, isn't it? So that explains my
Yeah.
idea, or that explains what I was talking about, no uncertainty. So there's no risk. Are you getting me? There's no, I'm not sure of something in the future. In as much as their Cvpa has told you that 15 naira is the selling price, we're going to use 15 naira. Are you getting it? In as much as Cvpa has told you that this is 100 naira, we're going to use 100 naira, except if the question changes the variables. That is when our answer here is also going to what? Change. Are you getting the flow?
Yes, sir.
Okay, now let us look at application of break-even analysis. Where the question can come up. Question A can tell you, determine the break-even point in units. Once you are told to determine the break-even point in unit, this is the formula. Determine the fixed cost of production and divide it by contribution per unit. Remember, I said contribution per unit, not total contribution. So if you are given total contribution divided by total number of units, you get contribution per unit. Does that make sense?
Yes,
So
sir.
what's contribution per unit? Selling price, I mean, minus what? Variable cost. So since this is contribution per unit, this is going to be selling price per unit minus variable cost per unit. That makes sense. Very simple. Option B can tell you to define what? To get break-even point in sales, which is in value. Our formula is going to be fixed cost all over, not contribution per unit. It's not going to be contribution margin ratio. And we are going to see the definition or the formula for contribution margin ratio as we proceed. Just hold on there. Now, if you don't want to use this formula, for example, the question did not give you information regarding to contribution margin ratio, because sometimes the question may not give you some kind of things. It is not left for you as a cost accountant to be able to determine them. If the question does not give you what contribution margin ratio is, what do? You can use break-even point in unit, multiply by what? Selling price. I've said this before. So this answer that you get here on that break-even point in unit, the question will give you selling price because it was the selling price that you use here, isn't it, to get your contribution. So you will say break-even point in unit multiply by what? The selling price. Once you do this, you also get what? Break-even point in naira or break-even point in sales. Another way that I can do it is by saying fixed cost all over contribution per unit, which is exactly this thing. They brought it here again, as you can see. Then that's a times sales price, which is also the same thing. So fixed cost all over contribution per unit will give us what? Break-even point in unit times the selling price per unit. That will not give us break-even point in naira. Does that make sense?
Yes, sir. So the second formula, BP unit times selling price, this selling price per unit or normal selling
Per
price?
unit, yes. Per unit. Break-even point in unit, total number of units multiplied by selling price per unit, that will not give you total. Does it make sense? Give you total.
And the contribution per unit is total contribution over total number of units.
Yes, that will give you contribution per unit. Are we good to go?
Yes, sir.
Okay, let's look at C quickly. Now, let us look at, listen to me, the level of sales in units required to achieve a predetermined profit before tax will represent the summation of fixed cost and the profit before tax divided by what? Contribution per unit. So you may be asking your question, what quantity should we produce to get a profit after tax of this amount? So if the company intends to get a profit after tax of say 10K, they are going to ask the cost accountant, how many quantity should we produce to get this profit after tax of 10K? What do? Say your fixed costs plus your profit before what? Tax. So this is profit before tax, not after tax, sorry. So this is profit before tax all over contribution per unit. Don't forget this formula is simply to get break-even point in units. So the only difference between this formula and this formula is the addition of what? Profit before tax. Are you getting it?
Yes, sir.
Good. Now, if the question has said profit after tax, which is known as PAT, then the formula is going to change. This one is still remains the same to get your break-even point in units. Then you are now going to say plus what? PAT all over 1 minus the tax rate. That is profit after tax over 1 minus tax. So this is the formula you are going to use. If you are being told to get the unit of products to produce to achieve a profit after tax of a particular amount, the amount is going to be given to you. That is the profit after tax. Just put it here. They say 1 minus the tax is maybe 30%. That is 0.3. So 1 minus 0.3 should give you what? 0.7. Are you getting it now?
Yes, sir.
So D is going to be the level of sales value to result in target profit before tax. Are you getting me? Is this. Remember, here is the level of unit required. Here is not the level of sales value. So the same thing applies. Fixed cost all over contribution margin ratio. Because we are trying to get sales value, not units. Yeah, if you are getting units, use contribution. If you are getting sales value, use contribution margin ratio. The same thing we did here. When we are trying to get a unit, we use contribution. When we are trying to get value, we use what? Contribution margin ratio. So the same thing applies here. So fixed cost all over contribution margin ratio, which is this. Fixed cost over contribution margin ratio, which is this formula, to give you break-even point in Naira, plus profit before tax. Are you getting it? Or you use this formula, which is an expanded form. Anyone is the same thing. Then come down. If you want to also get your sales value, that is how much will you get as revenue to get a profit after tax. This is the formula you are going to use. This one is the same thing. Fixed cost all over contribution margin ratio. So you just bring in part all over 1 minus tax rate. Does that make sense?
Yes, that's can you scroll up?
You get it now?
Yes, sir.
Okay. So all these things are just formulas, and the formulas are linked. Once you know the formula for BEP, you know the formula for every one of them, because all of them are all derived from the break-even point in Naira and break-even point in sales formula. Are you getting me? Now
Yes,
let's
sir.
come down to contribution margin ratio. Contribution margin ratio. So remember here, I told you that this contribution margin ratio, I'm going to tell you how to get the formula. So contribution margin ratio, let's come down. So what is contribution margin ratio? The word contribution represents the difference between selling price minus marginal cost, which is variable cost, or the summation of fixed cost with the net profit. So fixed cost plus net profit is also equal to contribution. I have seen questions where they will not give you selling price. Are you getting me? So you will not begin to say, how do I get my contribution since there's no selling price? Please, once they give you fixed cost and once they give you net profit, if you add it together, it will give you contribution. Does it make sense now?
Yes, sir.
The ratio of contribution to a particular sale value is described as contribution margin ratio. Contribution margin ratio simply means contribution divided by sales. Are you getting it? So that's why they say the ratio of contribution to a particular sale value. So that means contribution divided by sales is equal to what? Contribution margin ratio. Contribution margin ratio is also referred to as profit volume ratio. You always see it like this sometimes in your exam. PVR, determine the profit volume ratio. Are you getting it? It's the same thing. So what's the formula? Contribution margin ratio can also be in units. Contribution margin ratio can also be in total. And I said contribution margin ratio simply means contribution divided by what? Sales, which is selling price.
Yes.
So what is contribution? Selling price minus variable cost. Remember, we are dealing with per unit. Most of our decisions are per unit. So if this is per unit, we are dividing by what? Selling price per unit. Are you getting it?
Okay.
So for CMR in total, which is contribution margin ratio, or known as profit volume ratio, total sales, it is in total. That is in value. So I'm making use of total sales, not unit sales, minus total variable cost divided by what? Total sales. These are the formulas for CMR.
So is unit sales same thing as selling price?
Yes.
Okay.
Selling price per unit and selling unit sales is the same thing. Are we there?
Yes, sir.
Good. Now, when I say where selling price or sale value is completely omitted, and this is to say in a question where you don't have selling price or where you don't have sale value, what will be your CMR formula? Fixed cost plus profit, as I've explained before, that fixed cost plus profit is equal to what? Contribution. So fixed cost plus profit all over what? Contribution plus what? Variable cost. Total sales here or selling price here can also be calculated by saying contribution plus what? Variable cost. That's another way you can get selling price. So you can use this formula whenever some indices like what? Selling price is not given to you in the question. Does that make sense?
Will it be selling price per unit or just selling price?
In which of them? Contribution plus variable cost. It will give you selling price per unit. It depends on what you are using. If you are using contribution per unit plus variable cost per unit, your answer is going to be selling price per unit. You understand? If you use total contribution plus total variable cost, your answer is going to be total sales in units.
Okay.
So let's come down. Forget about this. Let's come down. You can go through this on your own. Let's come down to margin of safety. Margin of safety. So you always see something like this also in your question. So margin of safety. Now, this will represent difference between break-even point and budgeted level of activity. These are the key. So budgeted level of activity minus break-even point is known as margin of safety. What is the definition of margin of safety? Margin of safety indicates by how much sales may decrease before a company will suffer a loss. Margin of safety may be defined either in units, that is to say we have margin of safety in units, and we have margin of safety in value. So how much will sales reduce before the company start making a loss? Are you with me?
Yes, sir.
Okay. So if sales reduce, for example, now in this year we made sales of 10 million. That's good. The company is happy. Next year, the sales that dropped to 9 million. You know, sales is not profit.
Yes, sir.
Good. So when we made sales of 9 million, we were still making profit. But the manager was not very, let's say, accountant, please, this one that sales is dropping because of pandemic, or this one that sales is dropping because of election. How much will sales drop to before this company will start making loss? Because I know that sales now is 9 million and we still made profit of 1 million. What will sales be for profit to become negative? That is what we are trying to say, margin of safety. How safe is the company till we start making what? Loss. So the manager, the cost accountant will now say, okay, now that we have 9 million, sir, if sales drops to 8 million, we are going to be making loss. So that's what we mean by margin of safety. So how much will sales drop to may decrease before a company will suffer a loss? Does it make sense? Are you with me?